The information, opinions, and recommendations presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. This podcast should not be considered professional advice. Please consult your tax advisor, even if it's us, to find out how this may apply to your specific situation.
Hey listeners, and welcome to Tax Trails. Today, we're going to be talking about the One Big Beautiful Bill. Here are your hosts, Derek and Spencer.
Thanks, Chandler.
Thank you.
Welcome back, Spencer.
I know, welcome back. I'm dusting off the dust off myself from busy season.
Oh, yeah. Terrible time.
It was actually a hard one for me.
Was it?
It was, yeah, I just did more things that I haven't done.
Okay.
Like more client-facing things.
Oh, yeah.
Oh, yeah.
You're transitioning into more of that for sure, so.
Yeah. So it was more stressful, I would say.
Interesting.
I looked at my hours and they were pretty comparable to like what I did last year.
But the type of things you were doing was different.
Yeah.
It's just draining. I don't know about you guys, but like I could do 10 tax returns, but if I have to talk to like 2 real people during the day, then I'm out. I'm exhausted.
Well, like you would get calls and I would be on the phone for half an hour to an hour.
Right.
With just people calling in.
Yep.
For questions.
Which we love.
Which is great, but it is draining.
I don't mind it.
Feel free to call.
I know. I feel like you're on the phone all day with clients and stuff, and you seem to like thrive on it.
Yeah.
You get more energized as it happens throughout the day.
Yeah, maybe that has something to do with those typical personality types, like introverts and extroverts.
Yeah.
Oh,
right?
yeah.
My wife, she says she's an introvert. And what that means is that, like, social interactions outside of her family, like, drains her battery. But for me, maybe I'm an extrovert, and social interactions outside like that recharges my battery.
Yeah.
And so, yeah. Interesting.
I like the term, I'm a selective introvert.
Okay. Fair enough.
Our next podcast will be on behavioral science.
Yeah. The psychology of
why I need to take a nap after talking to one person outside of my social circle.
Yeah.
Sorry for that. So today we are going to talk about the One Big Beautiful Bill. It's a bill that encompasses a lot of different items other than income tax items, but we're going to talk about things as they relate to income tax because we're a tax podcast. So it was passed in the House on May 22nd, and so now it's over to the Senate. There was a little break there from Memorial Day, so they didn't necessarily jump right in to discussing and deciding if they were going to pass it or not. But they did. They do have a self-imposed deadline to pass it of July 4th this year. And so while it's in the Senate, they'll debate it. They'll potentially amend it. And since it is a budget reconciliation bill, it requires only a simple majority to pass. So it means that the Republicans can circumvent a potential filibuster option by the Democrats. So basically, sum it up to say there's a high likelihood of this passing, at least in some shape or form. And if they do make some changes, it'll go back to the House for their approval before it can go back to President Trump for signature and passing. And really, we are expecting in one way or another for this bill to pass, really, is basically where I think we're coming on that.
Yeah,
so,
in some form or another.
Yeah.
Which is nice that they have that deadline of July 4th.
Yeah.
And it gives plenty of time through the rest of the year to kind of dissect, at least for us on our side, for the tax changes to dissect it and go through.
Yeah, absolutely. If it happens July 4th, that gives us plenty of time to get ready for next tax season and also allows us to incorporate tax planning going into, because some of these items will take effect for the 2025 tax year, which we're already halfway through. So, the sooner we can get it passed, the better. And
Yeah. So on our schedule, what we're going to be talking about first, we're just going to talk about like the individual provisions. We think that the way that we're kind of scheduling this or structuring this podcast, most people will be affected, or I would say 99% of the people who file a tax return will be affected by these individual provisions. And then after the individual provisions, we'll go through some of the business provisions where it might not apply to as many people, but it still does apply to a lot. So
Yeah.
under this individual provision, so if we remember back in 2017 when Trump was in office, back then he made the Tax Cuts and Jobs Act, or TICJA is what some people would say, and he made these temporary provisions, and now they're trying to make a lot of them permanent in this one big beautiful bill. And so these, what we're the next couple of things that we're going to be talking about is just making some things that are already happening permanent, right? So, for instance, the tax brackets, the marginal tax rates are what we have right now. 10, 12, 22, 24, 32, 35% brackets will be made permanent, not temporary anymore. They're not kicking the can down the road on this one. Making those permanent marginal tax brackets. Also eliminating personal exemptions. So before the Tax Cuts and Jobs Act, you had a personal exemptions. They're eliminating that completely. They're increasing the AMT threshold, or alternative minimum tax threshold, making that permanent. Lowering the mortgage interest limitation permanent. So it was $1 million and now it's $750,000 for your mortgage loan interest limitation. They're also terminating the miscellaneous itemized deductions. So before the TICJA, there was a lot of miscellaneous itemized deductions, like writing off things that you paid for if you were a W-2 employee,
Right.
Those sorts of things. It would come back without this, but now they're permanently eliminating it, and then also permanently increasing the higher standard deduction amount.
And that one, more than anything else, is one of my favorite ones, just because that simplifies tax filings for such a huge majority of the American population.
Yeah.
So,
Well, and for those who filed returns pre Donald Trump's first presidency, a lot of people were itemizing.
yes.
And then increasing the standard deduction and taking away some of these other itemized deductions, the miscellaneous itemized deductions, a lot of people then switched from itemizing to being under the standard deduction.
Yep.
I think it's smart too. I think itemized deductions are one of those, like, if you end up getting audited, a lot of them get disallowed by the IRS or something as well, and so it's just kind of like, I think it
It simplifies.
It relieves burden on IRS,
Yeah,
on us,
yeah.
and everyone.
Simplifies filings for everyone.
Mm-hmm. But one thing that they are changing, that is different than what is kind of been the status quo, is the SALT cap. And we've kind of briefly talked about it in previous podcasts, but SALT just stands for state and local taxes. And currently, so with TICJA or the TCJA, they limited the SALT deduction from your itemized deductions to $10,000. Now, through this new bill, they would increase it to $40,000, and then you would phase that out if your modified adjusted gross income on your tax return is greater than $500,000 if you're married filing jointly, or $250,000 if you're single. And it would increase by 1% each year through 2033, and then remains solid after that. So then it wouldn't be adjusted. If this was to never be touched again, this is what it would happen.
Yeah, and there are some other business implications wrapped up with that I'll mention a little bit later as well.
Yeah. But for individual purposes on itemized deductions, that's what they're doing with this, and also the child tax credit. They're making permanent the doubling the credit. Essentially, it used to be $1,000, now it's $2,000, and they're actually increasing it to $2,500 from 2025 to 2028, and adjusting the $2,000 for inflation after 2028. So in 2020, after 2028, it'll go back down to $2,000, and then it'll adjust for inflation every year after that. So that's interesting for the child tax credit.
Yeah, it is. I really like that they're planning to adjust it for inflation. Honestly, that's one of those things that, like, yeah, okay, the 2,500, that seems like a good amount right now, but in 20 years,
right.
let's say, $2,000. We know, like, generally we're always inflating.
Yeah.
That $2,000 is probably going to be essentially worthless in 20 years. And so anyway.
Well, a lot of things are already adjusted for inflation.
Exactly.
Anyways.
So many other things are. Exactly.
And I think it brought into mind, people didn't really think about adjusting things for inflation that wasn't already part of the bill. And this is just my thinking, but because inflation was so huge the past couple of years, like everyone's like thinking about inflation.
Yeah.
So maybe that could be a reason. I wasn't in the meeting when they made this, but
you were in the room where it happened, huh?
Yeah.
Well, like maybe before they were just like, oh, well, next time we have some bill that passes, we'll just adjust it and that'll be good enough. But now with how much inflation's happening, they're just like, it's got to be in the bill to just adjust it on a yearly basis.
Yeah. Well, and also speaking for adjusting for inflation, talking about estate taxes. So before the TCJA, the estate taxes was about 5-6 million ish. And then now with it, they pretty much doubled it. But it was temporary. Now they're making that permanent. To estate tax goes to 15 million, adjusting for inflation.
Yes.
So.
Yep. That's a nice. So it's getting increased slightly. And then that's also planned to be, adjusted for inflation. That'll be a permanent change.
Yeah.
Those exemptions, were not necessarily permanent before this bill.
Yeah, so you might have heard if you were doing any like estate planning.
Yep.
And people were really worried that the estate tax exemption would be cut in half after this year. And everyone was like, you got to get your money out of your estate. And then now
it's double.
Now it's, and so now they're keeping it. So hopefully no one did too much stuff with their estate. But yeah, so those are pretty much the things that were temporary with the Tax Cuts and Jobs Acts, and now we're just making them permanent.
Yeah. So I'm going to go into some of the new items that are being proposed in this bill. So the first one, which we've actually heard a lot about from both sides of the aisle, is proposed no tax on tips. Interestingly enough, I didn't know that tip income was not subject to tax until the 1980s originally. So relatively, that's a new thing in our income tax world, right? For our professional careers, obviously, it's always been taxable.
Do you think that was just kind of like when the IRS, or when they kind of became aware that there was a lot of tip income out there that
maybe?
I don't know. I'm just trying to guess, like, why,
sure.
Why then?
I would imagine as time goes on, technology gets better and better. The ability of the IRS to actually track and find income has gotten better.
And underreported income.
Exactly. So underreported income is harder and harder to do and easier to find by the IRS.
Sure.
So that could play into it. Interestingly enough, so in this bill, it does not provide an exclusion from income for the tips, right? So you still have to report that tip income. If you have tip income, you've got to report it on your tax return. But what it's going to do is then allow a deduction for those tips after the fact.
On your tax return.
On your tax return. Yep. So you'll put it on and then you'll take it off. It's proposed, I think there was a $25,000 limitation on it.
So, when I looked through the bill, the way that the bill was written, this bill, they don't mention like a $25,000 like limit.
Got it.
But there was a new
there
was a new act that came out from the Senate of just a no tax on tips act.
A separate so there's a separate bill essentially that came out of the Senate that was all about just no tax on tips. That's the only thing it was, and there were some other rules and things in there, and that's what the 25,000 is. So
but assuming that, and it passed unanimously, so assuming everyone loved it, they'll do something. I'm sure
it'll probably be similar.
Very similar.
All right.
Yeah.
So one big beautiful bill, no limitation necessarily, no amount specified, but it
could change.
We may get to there. Okay. One nice thing is, so this will be a deduction that is irrespective of whether you're itemizing or taking the standard deduction. So you'll have that there.
Yeah.
But it ends.
It's temporary.
Yeah, so which I would I wonder if that will stay the case. Anyway,
The
yeah,
temporary piece.
the temporary piece. Yeah, if because everybody is very excited about this. It's surprising the support that it's had again from
Both sides.
Democrats and Republicans alike. So
Right.
who knows? But it's set to end in 2028.
Which is an election year, ironically. So
Yeah, annoying.
annoying.
So the other interesting thing, this kind of goes hand in hand. I view these very similarly in my mind anyway, is no tax on overtime. So there's actually like this is basically like a 2 sentence line in the bill, basically saying, "Hey, no tax on overtime," and not a lot
And
of
that's it.
rules, not a lot of rules written into what that means. Uh, and as a result of that, we'll be subject to the IRS interpreting what that means and giving us Treasury regulations on how to treat that. Um, but it'll probably be similar. You probably include the income and then take a deduction like you would on the tips.
Yeah, it talks about like what's qualified overtime, but then pretty much after that, it's
Yeah.
not a lot of regulation, like numbers wise.
Yep.
Right? And so,
Also set to end after 2028. Okay, this last one that I want to bring up is interesting and in general, this bill is set to increase the national deficit by like what almost $4 trillion.
I've heard $4
That's what
trillion.
I've heard.
So
Yeah.
a high amount. So great.
Our next episode will be on, why the national debt does or doesn't matter. I don't know.
And why we just
We're now
vote to increasing the
a national economics podcast.
Yeah.
No.
Look at the number and just kind of disassociate for a bit about it.
They're giving all these tax breaks, but they are trying to take back get some money back in some places as well, and some of those are in income tax areas and some are in other areas. One of the income tax areas they're going to do is they proposed a limitation on itemized deductions for high income taxpayers, and apparently this was a thing in the past called the Pease limitation. In my professional career, I've never had to deal with that, but what it will do is reduce allowable itemized deductions by 3% of the amount by which a taxpayer's AGI exceeds $500,000 or $1 million for married filing joint. And the maximum reduction in itemized deductions can get no more than 80% of the itemized deductions being reduced. So at a bare minimum, you'd at least get to take 20% of your itemized deductions. So I've got a little example of what that would look like. So say a single filer has an AGI of $600,000. That's $100,000 more than the $500,000 limitation. Okay. So 3% of that $100,000 is $3,000, and say they had $80,000 of itemized deductions, less that $3,000 limitation reduction, and now they've only got $77,000 of itemized deductions. So that's in theory how that would work, and specifically going after the highest earners in the country. So kind of interesting.
Yeah.
And I don't know the likelihood of that remaining or going away. I kind of think it's likely to remain, but
Yeah, interesting.
yeah. So let's go to the business stuff now, Spencer.
Yeah, let's talk business. So we just talked about like the individual provisions, and now so for business provisions, there wasn't as much that we thought that most people should know about. The big three that everyone was talking about, and were the big, not I guess I shouldn't say everyone, but the big three, at least that was on my mind, was bonus depreciation, Section 174 expenses, and qualified business income deduction.
Yeah.
And those three things are, I wouldn't say solved, but they have been re-put into place, essentially, except talking about the qualified business income deduction. That was made permanent. But not to get ahead of myself. So first, bonus depreciation. So if you're not aware of what bonus depreciation is, we were allowed with the Tax Cuts and Jobs Act to 100% expense depreciable assets in the year that they were placed if they met certain qualifications. Most assets ended up meeting those qualifications.
Yeah, pretty much anything other than like real estate, so like equipment, machinery, and things that had a 15-year life or less typically qualified.
Yeah, for bonus depreciation. So under normal circumstances, you would capitalize that asset. So if you bought a $10,000 5-year life asset, you would capitalize it, and for the next 5 years, you would take a piece of depreciation or expensing essentially over those 5 years. Through bonus depreciation, you can just take that full $10,000 in the year that you put it into service. They have brought that back, and so now it's 100% bonus through 2029 for property acquired after January 19th, 2025. So for this year that we're in, it applies bonus depreciation. So next year, as long as you bought the property after January 19th, why January 19th, I'm not really too sure, but...
I think I know why.
Okay, yeah, go for it.
So the inauguration day for Trump was January 20th. So it's essentially just from the time that his presidency started, I would think. I don't know, just based on like the majority in the House and who wrote the bill. It seems like a funny little like, why does it matter when you bought the property? But I'm looking at it, I'm like, I think that's got to be the only reason why they choose this random day.
It's not a coincidence.
But it's just like,
I'm sure that's it.
Why?
Yeah.
So yeah, if you bought a piece of property since Trump has been in office for a second term,
yeah,
then you get this 100% bonus depreciation.
Too bad if you bought property in the first 20 days of the year.
Which, yeah, who knows? But then it's only temporary, so it goes through 2029, and then it will be taken out in 2030. So that's one big thing. Section 174 deduction. So those who are not aware of Section 174, like what does that even mean? It's just research and experimentation expenses, or you might hear R&D, research and development expenses as well. So under the Tax Cuts and Jobs Act, so before the Tax Cuts and Jobs Act, you could expense all of these research and experimentation expenses in the year that they were incurred, essentially. However, as a revenue raiser in the Tax Cuts and Jobs Act, they took that away, I believe, starting in 2022. So starting in 2022, you had to capitalize those expenses.
Yeah, capitalize and then deduct them over 5 years, right?
Yeah.
So
essentially. And so what this did was to help kind of raise revenue in those years that you started. So now they're reinstating the deduction, but only for domestic research and experimentation expenses. So if you have any foreign 174 expenses or research and experimentation expenses, those are still capitalized and amortized over 15 years.
Oh, yeah.
But for domestic expenses, now you can immediately expense them in the year that they're incurred. And this actually was retroactive January 1st, 2025 to December 31st, 2029. So through 2029, essentially. So that's really nice. And a lot of people, I'm sure, are happy that it's in there, but there might be still some gripes. We're just kicking the can down the road. And when 2029 comes around, we're going to have this issue all over again, unless they make it permanent.
Yeah.
Well, it's interesting, like when it first started in 2022, it was kind of like you capitalized it and you were kind of losing a lot of deductions, but because most of the people that capitalize this, they have the same type of expenses every year.
Yeah, or it goes a little bit higher or whatever.
And so it's like by year 5, you have kind of a mix of everything being deducted over the last 5 years that you're carrying out. And so now you're not really seeing any difference on your return.
Right.
If you did it long enough, but now it's kind of like, now with the flip-flopping, it's just kind of like, oh, you kind of got a little screwed the last couple of years, and now we're going back to expensing it, and then we'll see what happens in 2029.
Yeah.
Yep.
Well, and then so in 2025, you're going to be fully expensing your current year 174
and still deducting
prior year 174.
Right.
So now in 2025 and 2026,
You're going to have excess
you're going to
deductions.
have exactly.
Yeah.
So tax planning, maybe you want to get some more money, like maybe accelerate some of your income because you're going to have more expenses. I don't know. maybe that's just
Yeah.
a possibility. So if you're thinking of that, and then the last of the third pillars of business provisions, qualified business income deduction. So this was set to go away after this year, but now they're making it permanent, and they're actually increasing it. So what it is essentially, your qualified business income, you get a 20% deduction on your personal tax return. So qualified business income is only for like flow through entities, so partnerships, S corporations, or sole proprietorships. You have access to this qualified business income deduction. If you have a C corp, they don't have this. So qualified business income deduction. Let's say your net income is $100,000, and then you get 20% as a deduction, so you get to take $20,000 as a deduction on your tax return. Now they're increasing it from 20% to 23%. So now if you make that $100,000, your net income is $100,000, then you would take $23,000 as a deduction. And they're also changing. I know that they're also changing some rules and limitations within like QBI.
Yeah, there are special rules on what sorts of businesses and who qualifies and what income qualifies and when it qualifies. So it's not just a straight calculation necessarily.
Yeah, it's actually quite complicated.
Yes. But in general, we talk about it as just 20% of your net income from your flow through entity, but there are many rules that go into that actually.
Yeah.
And they're looking at changing some of those rules.
Yeah.
Essentially.
And I don't know,
Are they looking to make it less strict or more? I don't know.
Well, I think they're going to change the wording of like SSTBs, special service trader business.
And I think that was actually going to be a little more narrow too, is my understanding. So less businesses would probably fall under specialized service trade or business.
Okay.
And those entities, if you're an SSTB, you've got special rules on how much of a qualified business income deduction you can take.
And they're doing, because there's limits. There's like certain limitations depending on how much like your adjusted gross income.
Yep.
And they're modifying those limits. So I'm not really too sure exactly what it's going to look like at the end.
Right. I think the important thing is to note they're making it permanent and they're increasing it from 20% to 23%.
Yeah.
And then some of the qualifications are going to change.
Yeah. Which, if we remember, they did. So this wasn't even a thing before the Tax Cuts and Jobs Act.
Right.
And they did this as a thing because they lowered the C Corp rate from whatever it was, 28% to 21%. So now they're increasing it from 20 to 23%, which gives you even more of an incentive not to have a C Corp, essentially.
Yeah.
So they'll probably be less wanting of making a C Corp, possibly.
Okay. So on to the green energy items that are part of this bill. And really what this bill is doing for green energy is saying we don't care.
Yeah.
Big middle finger to green energy provisions.
Essentially, it's going to terminate or incredibly reduce after 2025 and some after 2026. So the previously owned clean vehicle credit, the clean vehicle credit, commercial clean vehicle credit, energy efficient home improvement credit, residential clean energy credit, new energy efficient home credit. Some of these, they're drastically increasing phase outs or just completely eliminating all within the next year or two. So
if you're going to buy an electric vehicle.
Yeah, this is the year to do it, honestly. I'm kind of surprised that they're proposing this, honestly, too, with Elon Musk being so involved with Trump on a lot of stuff.
Right.
But, I guess maybe that's good.
Well, part of this is another revenue raiser.
Exactly. Yes, 100%.
We need money somewhere. We can't just give out these credits anymore, right?
Yep.
Right.
And
So
But yeah, if you're going to buy a clean energy car,
If you're going to buy it used, do it this year. If you're going to buy a new one,
You have another year.
You have another year.
Yeah.
And if you're going to like improve your home, your home's energy or whatever, like get a new HVAC that qualifies.
Yeah.
First of all, make sure that it qualifies. I did a return for a new client this year, and they said that they had their HVAC people told them that their new air conditioning qualifies, and then it
didn't.
actually didn't. Yeah, because
Oh,
I went,
interesting.
I researched it, and I was like, I'm not seeing that it qualifies anywhere on
There's a list of what qualifies.
yeah, that comes out from like the government, a list of models.
Right.
And then so I was like, do they have any documentation? She reached out to them and they said, oh yeah, it doesn't. So just make sure that it.
we do a whole episode on those salesmen that tell you get a tax credit for,
Yeah.
for this thing and then don't.
Oh yeah. That's
Yeah.
a big deal with solar, all sorts of things.
Yeah.
Yeah.
Anyway.
So yeah.
Well, yeah. So that's that. Beware. Plan those items accordingly.
Yeah. Don't necessarily just buy a vehicle just to get a credit, but if you're already thinking of it, it might be better sooner rather than later.
Yep.
Moving on, there's some things that's changing within the IRS. Not a lot that we think is noteworthy, but they're terminating the direct file program. So there was this the IRS came out with this new direct filing program that was free for taxpayers, and a lot of people used it. They kind of did a rollout method depending on what state you were in. I think they started this a couple years ago with a small number of states, and then they kind of just rolled it out to more and more people. And I think from what I understand, a lot of people liked it. But what they're doing is they're pretty much just kiboshing the thing now, and they want to. Let me just kind of read exactly what it pretty much says. Yeah, so they just wanted. Oh, let me see.
Well, what my understanding is, they're essentially just going to partner with some of the private entities. So thinking TurboTax or whatever, those are going to be people where they're going to allow you to have their free file option still, and you'll do it through something like that instead of this IRS direct file program.
Yeah, and from what it sounds like, it's like what I'm going to read right here. The bill requires the termination of the program and appropriate funds for the IRS to research a public-private partnership to replace the current free file program. I'm assuming they want to partner with someone so that they could maybe save funds and put it somewhere else, possibly.
Right.
I'm not
Just reduce
system-
their burden for their infrastructure to accept everything. And
Exactly. It's not a
Yeah.
system that they're going to have to maintain and
manage.
hire
Yeah.
programmers and whatnot to do. They just say, okay, we'll partner and facilitate TurboTax from doing it or whatever.
And they might partner with multiple. Who knows?
Yes. Hopefully they do.
Right.
Yeah.
TurboTax is just the name that comes to mind for us when we think
Yes.
of this kind of thing. So that's what we're using, but we don't know it's them.
Yeah. So they did that, and then there's it's so funny. More ERC penalty stuff. I feel like we just can't get away.
So I was reading that, and not to get too conspiratorial on you, but it said it was limiting a maximum penalty of up to $200,000 for promoters, potentially ERC promoters.
Is that lower than what it
Well,
there was no maximum before, right? So
yeah, I don't know there was no maximum before. So honestly, this is throwing a bone to the promoters and essentially letting them get off scot-free when they made billions of dollars.
Right. I mean, 200,000 for some of these promoters that were in it heavy is nothing to compare to the amount of money they made.
That was my quick interpretation of it, and maybe
So do you think this is a way to incentivize them to come clean so that they would actually pay that 200?
possibly. I do know that the proposed IRS director was an ERC promoter. So
Nice.
Again, we're not getting the tinfoil hats on.
sorry.
But
These
are all facts that we've
This
said.
is my niche.
This is my,
Eric works a lot with ERC.
I love the ERC. It was really fun to work with, and I have
This is our around the campfire conspiracy.
it is. Yeah.
Tax campfire conspiracy part of the.
So
pod.
anyway, that's that. Some housekeeping, or not even housekeeping, some other items that are proposed in this bill that are tax related. So there were these MAGA savings accounts. They've changed the name to Trump savings accounts. Essentially, a tax advantaged account that can be set up by parents for children 8 and under, or under 8, I guess. Up to $1,000 can be put into this account, and then it grows, and it's only going to be subject to capital gains tax rates. So
Interesting.
that's one thing.
Is it? You mean you can only contribute to it when the kid is 8 and under, and then after that, it's just the funds just sit there for?
No, from what I understand, and you can correct me if I'm wrong, but the government puts in $1,000 and it opens up a savings account for your child.
Oh,
So under 8, the under 8 thing I think is to catch kids who sounds weird, catch children who've missed out on this program in the past like 8 years or whatever.
okay.
And then now, like starting now until like all the children that are born from now on will get like $1,000 put into account. You can opt out if you want.
Okay.
But then from what I've read online, and I don't know, this could change or whatever, from what I've understand is it's meant for like a education savings essentially. So like when they're 18, they can take it out for education savings or educational expenses. And if they don't use it for educational expenses by the time they're 30, it just essentially rolls over to like an IRA or something like that.
So they're somewhat comparable to kind of like the My 529 plans that we have
Yeah.
here in Utah.
Yeah, it's just like a
Kind of.
federal thing instead of a state,
Okay. Interesting.
from what I
Are
understand.
they called
Yeah,
Trump savings accounts?
Trump savings accounts.
That's fun.
Yep. Car loan interest deduction for cars assembled in the United States.
Oh.
So maybe that's throwing another bone back to Elon because Teslas are manufactured in the U.S. Then the interesting thing about this is this theoretically will be available whether you itemize or not as well. So a little incentive there to buy American. One that I thought was interesting is credit for donating to scholarship granting organizations. So that's already a charitable deduction,
Right.
okay, depending on the situation, but theoretically that's already a charitable deduction.
More than likely, yeah.
Yeah, and now there's a proposed credit. Not a lot of details on what that credit will be, but that's kind of cool.
So you could potentially get a charitable deduction and a tax credit for donating to this charity?
Typically there's probably not that. Typically we can't double dip, but credits are more beneficial than charitable deductions.
Right.
So
I feel like if you're not itemizing, then you might still get a credit for donating
Yeah.
to them or something.
Yep.
That's cool.
So there's that. That's cool. I volunteer with a scholarship granting organization, so I don't know. That could be cool for us.
You'll probably see it a lot more.
It might help us raise more funds, which is great.
Right.
Expansion of qualified expenses in 529 plans. So you mentioned that, Chandler, of 529s. Those are, education savings accounts, and those are like they're an account you can put money into, and if you pull the money out for qualified education expenses, including the earnings, so that's a tax-free deduction. So you can go invest this money, pull it out, tax-free, theoretically. They're expanding what are qualified expenses to include elementary, secondary, and homeschool expenses. Previously, it was for
higher education.
For post-secondary school, yeah.
Interesting.
So that's cool. Allow for charitable contribution deduction for non-itemizers. This was a COVID era thing that happened for a couple years. It was a $300 above the line deduction. That's in this bill, proposed to bring that back.
Is that a permanent or like a temporary till?
I don't know,
Okay.
but
it's there.
It's there.
Yeah.
Enhancement of opportunity zone. That's not something we deal a ton with, though, but there are special considerations you can get when you invest in opportunity zones. And you can think of these as areas that are in need of additional economic development, places that, and they're all over the country, places that are maybe a little bit downtrodden and could use from
Like
a societal perspective, could use investment from business to help
Yeah, it's just
bring an area back, right?
Yeah.
Places where there's maybe a lot of issues, a lot of poverty or things like that. If they incentivize businesses to go and invest and
like building
build
a factory.
build a factory or
hire
build
employees.
Exactly. So there's looks like maybe an expansion into those opportunity zones, what those might be, and maybe what benefits you can get by investing in them. And then the last thing is an increase in Section 179 limitations after 2024. Section 179 deductions go hand in hand with our, depreciation deductions, and they're proposing to increase the limitations on those.
So it'd be better, I guess.
Yeah.
But we have bonus, so.
Exactly, which is great. We're all big fans of bonus depreciation, simplifies tax filings and tax planning.
179 is good too.
179 is fine, but it increases complexity, especially when you factor in federal to state differences and things like that. So
please don't remind me.
There's a tax return Chandler and I work on together, and anyway,
they file in like every jurisdiction imaginable in the United States.
And the Section 179 expense this year would have been larger than their bonus depreciation expense of 40%, but due to the increased complexity and compliance for filing in all those jurisdictions, we elected not to take 179 this year. It's not a huge amount. We were talking like $20,000 or something like that. So
not a huge amount to them.
Not a huge amount to them, right? It's a yeah. So anyway, but yeah, Section 179. We'll see what happens though, Spencer and Chandler.
I'm honestly like very excited.
I know
Which sounds weird.
It is nerdy. This does make our job fun. It seems like there's always, this increases our. It's what we get excited for as tax guys.
I was always like, in the beginning part of this year, I'm like, when are they going to tell us? Like,
right.
When are they going to let us in on what they're thinking, what they're going to be doing? Because there was a lot of talk of, well, this is how President Trump's first term looked like. So we're thinking the second term is going to look kind of like this, but we never really knew.
Right.
And you never know, like, when they start talking about tax policy on the campaign trail, how much of that is actually going to be put down on paper, right?
Oh, yeah.
Right. Like, sometimes things like no tax on tips or no tax on overtime on a campaign trail just feels like, a really fun idea that gets people excited, but you never know like how concrete it's actually going to go through or what it's going to look like on the other end.
Yeah. So it's great having no matter what, if you like it, you don't like it or whatever, it's cool to look through and to learn, and hopefully we get, hopefully they keep that July 4th deadline. And
yeah, I saw, so that's their self-imposed deadline. There was some questions out there from one of the research tools I was looking at, and they're saying they're not sure how realistic that timeline is.
Yeah,
really.
But that's the GOP's self-imposed deadline to get it done. So,
well, you never know.
Hopefully, that means even if it's not July 4th, hopefully that means it's close to.
It'd be really nice.
In July would be fine.
Yeah,
right.
Like you said, for tax planning, it just makes it. I mean, it gives you so much time to like understand the differences and then still do things this year.
So personally, I start looking at September as a time to do a lot of tax planning with clients because, you're 3/4 of the way through the year and you kind of have an idea of what you've done and where things are headed for the year. So it's a good time to really lock in what your plans are for that last quarter of the year and do what you need to do to prepare for tax time in 6 months' time from there. So hopefully it happens before September and we can fully take advantage of whatever is included in this bill.
Mm-hmm.
And whenever it does pass, we'll probably end up doing a quick follow-up episode just to kind of discuss, what the final bill actually did look like, what stayed in from this episode, what got added, what got removed, and stuff like that. So you can keep an eye out for that as well.
Yeah.
Awesome.
Well, thanks everyone so much for listening.
Thank you. See you on the trail.
more information about Larson & Company and other educational material, you can find us at our website, larsco.com, also linked in the show description. For questions or suggestions on future episodes, you can contact us at larsonpod@larsco.com. If you would like to learn more about today's episode topic, additional resources can be found in the episode description.